astronomical. They're going to get worse.
What can I do? I ain't gonna walk and catch the bus.
It's a lesson in global economics taught at the local gas pump. You can see it on the sign at this station in Oakland, California, $5.69 a gallon. Prices are higher in California thanks to state regulations and taxes, but everyone is paying more, about 50% more than last year, and prices will likely only go up.
It'll alter my driving pattern if it keeps going up, especially.
Demand is high and supply tight coming out of the pandemic. The war in Ukraine is only making it worse. It's all because of the way oil is priced.
There's a global price, and disruptions or interruptions or price spikes anywhere lead to price spikes in the United States. So we're much more connected, even though we only import a tiny amount of Russian oil.
What's driving prices now? A pullback of supply from Russia, the world's second largest exporter of oil. Adding to that, an old enemy of any market, fear and uncertainty.
Buyers of Russian oil, companies, traders, shippers, have become afraid to touch it because of the growing risk of sanctions.
Now, the U.S. is banning imports of Russian oil.
This is a step that we're taking to inflict further pain on Putin.
But the U.S. only imports a small amount, mostly something called mazout, a kind of heavier fuel oil that goes into refineries and comes out as diesel and gasoline.
The implications for U.S. consumers in terms of prices at the pump is pretty minimal compared to the huge increase in prices that we've already seen.
Mark Finley is at Rice University and was an economist at BP and an energy security specialist at the CIA.
It could, provide a opening gambit in a broader effort to try to squeeze Russia. Oil is half of all of Russia's exports. It's 40% of the government's revenues.
You may think the U.S. can just drill more, pump more, rely even less on oil from other lands. It already produces most of what it uses. But it's not that simple.
The oil and gas industry has millions of acres leased. They have 9,000 permits to drill now. They are not using them for production now. That's their decision.
A decision revolving around booms and busts and the low oil prices of years past. It's all enough to worry energy company executives.
You want to be really sure that the risk of another price collapse has gone away before you start to invest a lot more.
It's likely other nations, including much of Europe, won't be so quick to ban their use of Russian energy.
There are specific countries in Europe that depend on Russia for up to 80% of their supplies.
It's possible U.S. gas prices could spiral toward $5 a gallon for everyone. There's about a 3-week lag between these prices and what oil is going for.
Introducing the all-electric F-150 Lightning.
So what about cleaner energy, hybrids, electric vehicles? These still account for a small percentage of sales. Automakers have plans to make more, but this takes time, and it takes raw materials and metals to make batteries and chips. It's material already in short supply, and big chunks of it comes from Russia and Ukraine. So how does all of this end? Analysts say either tensions lessen, taking the edge off prices, or there's a recession that smothers demand.
My prediction is tremendous volatility and uncertainty. Buckle up because it could be a pretty wild ride.